Welcome to TheoTrade. This is Don Kaufman. It's February 28th, 2020, and you are watching the TheoTrade Weekend Update. Listen, few words can really describe some of the action that we saw in this past week of trade. Absolutely epic sell-side activity. Really, going back in my career only to the likes of maybe 2008, do we have anything to truly compare this to? But the overwhelming question, are we really on the verge of a bear market? And we're going to go deep into some explanation here momentarily. We're going to look at a couple of charts, a few of the trades that we effectively had on, and try to specifically answer that question. We're also going to talk a little bit possibly about the Fed. Why? Because right now, it's like the markets know something. They're already pricing in a 50 basis point cut coming to a Fed meeting near you. And this is actually something I talked about on last weekend's update. It would not surprise me at this point to see Jerome Powell pop up and actually do, again, a surprise rate cut. People, the sell side activity has just cracked wide open. It's Pandora's box of sell side activity. We have not seen anything like this, again, in many years. You can't compare 2018. You can't compare the VIX explosion of early 2018. Again, you got to go all the way back into the time of like the financial crisis to see this kind of perpetual sell side activity. And I'm going to tell you right now, and I don't want to leave you hanging, okay? There's more sell side to come, and I'm going to explain precisely why here momentarily. Before we do that, I'm a quant. I like to throw a couple of statistics out at you. In this week, let's not focus on, the percentage loss of the marketplace. Sure, we can discuss that until we're blue in the face. It's about statistics to me. It's about the fact that the marketplace, okay, specifically the expected move, something we mentioned, okay, week in and week out on these updates, the expected move of this week of trade was $54. The actual move, north of $380. That's a 7 standard deviation move, which again, I'll explain in a bit more detail here. For those of you that speak math geek, it's completely impossible to see moves like this. This is absolutely, if you will, one of those fat tails that happens in the marketplace, the complete unexpected. Yet, if you were positioned right, which we absolutely unequivocally were, this was an absolute, again, epic week of trade. Sure, we have only slept, 3-4 hours a night? If you're anything like me, you're up watching the S&P futures literally in the middle of the night. Last night, specifically 2 a.m., when they're down 67 handles. Again, you don't want to miss a second. But now, this is all in the past. We got to look forward. We got to look forward because now, okay, we're in the throes of it, and we got to harness the volatility, take advantage of it, okay, and put ourselves, okay, positioned now. Again, everything is from this point forward. With that, let's get down to it. We're going to break down a couple of trades, okay, and specifically some of the action that we can expect moving forward. To the charts and trades we go. On the verge of a bear market. Again, in a week like this, it's almost difficult. Like, where do you even begin to start to talk about the overall marketplace? Well, right now, to begin with, we're not going to focus on too many individual stocks. This now, it's about the entire market. It's about the economy. It's about the Fed. And that's exactly what I'm going to try to zero in on. The first thing that I want to discuss, okay, is this just outlandish move that we've seen inside of the S&P. And again, I'm not talking about on a percentage basis. I'm talking about, okay, the quantitative side of the move. For those of you that do tune in week and week out, I talk, again, just ad nauseum pretty much about expected move. And I'm boxing in a very specific area. And the reason I just boxed that in on your screen is what you had here, okay, was 23 consecutive weeks of being inside the expected move, which just, if you will, reeks of efficiency in the marketplace. The marketplace is docile, it's efficient, okay? And week in and week out, I scream to people, I'm like, whether you should be buying premium or selling premium, Well, really, in the last few weeks, and this is what's important, in the last few weeks, we talked about how the marketplace started cracking through its expected moves. And again, these expected moves, what they're based on is based on the option price. If the option marketplace, and I'll just give you an example, this past week, right? This wild and woolly week where we had basically a 380-point move down in the S&P. The week was pricing in a $54 move. And again, I want to highlight that for a second. We're pricing in a $54 move. But we have been warning now for, look at this, 1 week we breached, 2 weeks we breached, 3 weeks we breached, 4 weeks we breached, 5 weeks we breached, 6 weeks we breached. After 6 weeks, I warned you that this was going to end horribly for premium sellers. And here we are. It's a 7 standard deviation move. What does that even mean? Listen, the market was poised to move 54 points. 54 points, when you say 54 points higher or lower, what was the actual move? Oh, about 380. Okay. Oh, how many times does 54 go into 380? About 7 times. It's 7 standard deviation move. Just outlandish in terms of a move. And when I say that we warned you about it, I'm actually going to scroll down because here's last weekend's bullets. I told you last weekend that fear is coming to the market. I told you last weekend, that you're on notice, that a big move is coming. And really, to get just wildly specific, expected moves are projecting extreme risk as the option markets were failing to accurately handicap expectations. We showed you that, We said, don't sell premium. Buy it with both hands. And I'm telling you, you had to be a buyer of volatility. And that's why, again, I just get, nuts about this stuff because this is what trading is about. It's not about being right or wrong. It's about having on positions that are going to work for you, right? In markets that are going to do, again, outlandish things. So the SPX expected move, $54. We hit 380. This next week, check this out. It's a $182 expected move. I got to actually bring you to the option chain because that's one I had to do a little bit of a double take. Here we are. The March 6 expiration, that's 182 on a 53% implied volatility. It's real now. Now, I'm going to move aside from the expected moves. I'm going to move aside from the standard deviation talk. That's me. I'm a quant geek. I get into it. The next thing that is of critical importance to you, gravity points are so very, very back. All right, for those of you, that have no clue what a gravity point happens to be, people, draw them on your screen. These, were very specific levels that I was able to pull out. The last time these gravity points were in play was October, mid to late October of 2019. Now, the gravity points, they're based on concentric areas of risk of major derivative firms. People often say, the market doesn't have a great memory. Yes, it does. The algorithms that are actually trading in the marketplace absolutely do. That's what artificial intelligence is so wonderful in this business, right? These gravity points, 2983, 2911, 2842, 2811. Just put lines on your screen at those levels. We will explain extensively more this coming week about the use of these gravity points, what they're good for, and what you should be looking at. And if you don't necessarily have any clue, what you are looking at, first of all, today, one of the most wild moves that we've seen in recent history. Listen, neither here nor there whether the S&P's finished up or down. Look at the range. Basically traded 3,000, down to 2850. It's a 150-point range, just shy of a 150-point range. And yet, we adhered, very, very closely, to these levels. The 2911 was the central inflection point of trade today. To the upside, 2983. And again, you can even see these levels, and we're adhering to the levels in overnight trade. We're adhering into the lower levels. We just came shy of 2843. By the way, you crack under 2843 and it is serious. But gravity points are so very back in style. If you don't have them, if you don't know them, get in the know. They're on your screen right now. All right. Now to answer the question. Again, I have been flooded with emails. Is this going to continue? What are we in store for? I can't tell you on a day-to-day basis, okay, what we're going to look like, what we're going to feel like. As soon as we get into these gravity point areas, I get a pretty good feel, and I can say, all right, we're at 29.83. We're going to bounce, we're going to fade. We're actually going to ping back and forth between these gravity points. Again, a lot more on that, okay, as we come into early next week. Now, the reason I don't want to go out on a limb and say like, well, we're going to rally here and sell off there. Listen, we all know that Jerome Powell sooner or later is going to, pop out of the woodwork and probably say that that's it. Okay, we're going to cut. We'll come to that here momentarily. But I'm going to argue, as I did a moment ago on the video portion, the extremes of selling are far from over. Okay, let's start to dig into why. Banking on a rally, that might hurt. Now, a lot of you guys are trying to bank on a rally, try to buy the dip a little bit here. And you can start to go in some of the tech companies. You want to buy some dips, you go buy some dips. Okay. But if you're going to do it, you better do it with defined risk. All I'm saying is, all right, listen, banking on the idea of a rally in a marketplace like this, okay, could be the death of you. Just can be the absolute death of you. If you're going to do it, define your risk. And by that, I mean, use things like in-out spreads. One strike in the money, one strike out of the money, short duration, in-out spreads. Okay. Do not, under any circumstances, use single options. Don't go out there and buy a call. You buy a call, you're dead. Because the second that we rally, they're going to vol crush this marketplace like there's no tomorrow. Second point over here, the path to global growth slowdown is totally paved. If you miss this, right, and again, I just want to hit a couple of key points over here because people are going to say, like, why do you think a bear market's coming? Okay, listen, the extremes of selling, maybe it's over for next week. Maybe it's over the week after that. But they're going to come back. Again, Pandora's box is now open. So, again, be careful banking on the rally. Define your risk. Second point over here, the path to global growth, the slowdown, it's paved everywhere this week. Okay, and this, again, a lot of the global growth concerns were there before COVID. They were there before the virus. All right, so again, push the virus aside. Japan has clearly stated, and the Bank of Japan has clearly stated, 2% growth is nowhere in sight. They're going to go deeper into negative interest rate policy. All right, you're actually hearing horrible news specifically out of areas of Europe. All right, Germany, to be more specific. All right, I'm going to move past that because, again, you're going to hear much more about global growth slowdown and really supply chains being, disrupted. That is virus specific. All right. This is the big one. Okay. Right here, right now, you need to expect, a lot more firms are going to warning on shortfalls. We've actually heard from the likes of Apple. And Apple, it's not so bad. They're getting ramped back up in production. Okay. Neither here nor there. Yeah. You heard from Microsoft. Okay. I got it. Those are the only two big ones I've really heard from. A couple here, a couple there. Just wait, okay? Because guess what? That's why they call it the S&P 500. There's 500 other companies out there that could possibly worry you. You've heard from what? About two of them. Look for more firms warning about earnings. That's coming to a theater near you. It is not going to be easy. With that, okay, we have to actually worry about capital constraints. Stock buybacks are going to rapidly disappear. There's just no question right now that we're on that path. I don't care. So what? The Fed's going to lower interest rates. Great. They're going to make it dirt cheap to be able to buy back stock. Great. Nobody's going to want to buy back stock. It's over. It's over. It's done with. Okay. Why? You kidding me? You can't. Stock buybacks are totally going to disappear. You're going to run short of cash. Have you seen what some of these sectors have done? In fact, I'm going to show you one of these sectors here in a moment. Okay. Yeah. Here's a sector that's doing a lot of stock buybacks. You like that? It's called the energy sector. You know what the energy sector is looking like right now? Look at the year-to-date percentage, down 25%. Okay, if you want to look at the oil and gas ETF, XOP, it's down 35%. They're getting devastated. Okay, maybe we should go to some place that pays big dividends, something like, the utilities. Utilities have gotten slaughtered this week. It just goes on and on. All right, if you think stock buybacks are going to save us right now, all right, maybe some companies like Apple and Google, are still going to continue to do so. But again, vast majority of stock buybacks are going to disappear in the very near term. All right, next point on here, retail fund redemption. It has begun. What that basically means, you're mom and pop that maybe go out there and sell a covered call once in a while, trade a couple of option strategies, but you've also got a 401k, you've got an IRA, and I guarantee that some of you had a couple of sleepless nights this past week regarding some of this volatility. And if you have, you're not alone. Okay. Retail fund redemption has begun. That's people starting to whack out of their 401ks and so forth because they're getting nervous. Again, here's evidence of it. Why? What is this? What am I looking at over here? This is consumer staples. Why am I looking at consumer staples? Okay. There's no real reason to be selling consumer staples. They would actually be doing well. Okay. There's a virus coming. They should be doing fairly well, right? Consumer staples. Everybody needs this stuff. The only problem is consumer staples, okay, are one of the pivotal areas, okay, of portfolios like your 401k. And what happens is if the S&Ps start to sell off, okay, they're actually going to hit consumer staples along with it. And that's exactly what you're seeing here. This isn't about not liking consumer staples. This is about the fact that people are running scared. All right. So retail fund redemption has begun. All right. Watch those financial stocks. They hold the bag of risk. Let's actually move on. Okay, specifically to the XLF. The XLF is critical. Why is the XLF critical? For those of you that have been around a while, okay, I've talked about the 2650 level inside of the XLF pretty much ad nauseum. By the way, we hit risk twist spreads in a ton of these. The XLU, the utilities, we hit a risk twist spread. We hit a risk twist spread in the financials. We hit a risk twist spread in the spiders. I still have one in the home builders. Okay, absolutely knocked it dead buying volatility. Okay, in some specific ETFs this week. But 2650 is marquee level inside of the financials. Watch this. When I say they hold the bag of risk, okay, the financials ultimately, well, guess what? They are holding the risk for a vast amount of the firms out there. And as soon as you start seeing just wild sell-side activity like you did this past week, the financial strains, okay, to the entire system are going to be felt specifically inside of the XLF. And the reason that I'm really detailing the XLF on a percentage basis, okay, today, that was not a good performance. You know, I saw the marketplace rally back up, but the financials continue to get hammered, which, lo and behold, tells us this thing is far from over. All right? Next thing on the list here, the VIX in the bottom of the marketplace. One of the things I would like to remind everybody, okay, if the marketplace continues to see any sell side activity, the VIX high is rarely indicative of the marketplace low. And I'll give you a quick example, because the only examples I think that would do justice, I mean, we can go back to like the maximum time frame in the VIX, and there's huge spikes here. And again, if you come back, and I'm just going to give you a quick glance into 2008, and I'm not necessarily comparing what's going on right now to 2008, although I will say this, okay, this was a week as bad as I recall in November of 2008. But I want to remind you of something about the VIX. The VIX spiked, okay, in October, all right, and these are actually month candles. September, October was the absolute spike, okay, and November. So those 3 months were the spikes in the VIX, and they were consecutive months. However, if you'll recall, when the financial crisis ended, it was March 9th, okay, of 2009, when the S&Ps bottomed at a much lower volatility. You're reminded of that simply because you saw a VIX spike and you're thinking, it's time to buy. Why? Why is it time to buy? This volatility could very well subside substantially with the marketplace continuing to go lower. Listen, the risk monkey is out of the bag. Once the risk monkey's out of the bag, the volatility can collapse back down and the sell side activity can just keep on coming. So don't tell me that the VIX, okay, indicates the bottom of the marketplace, because in every bout of major sell side activity, okay, that is prolonged, the VIX being at the high was not the bottom of the marketplace. Moving along over here, can the Fed save this marketplace? Well, we got to ask that question because a 50 basis point cut is now fully priced in. I'll be very specific with this. The Fed is pricing in a cut at this point. In fact, what you're looking at over here is the CME. It's the Fed Watch tool. And in this Fed Watch tool, what I'm actually getting into over here, Fed fund futures rates are actually over here. What's over here? Okay, the Fed fund futures rates are not even listed on here because the marketplace is giving no chance. There's no chance right now of the Fed not cutting. So if you're unfamiliar with where the Fed fund futures rates, they're 150, okay, 175. That's what the Fed fund futures rates are. they're giving a 43% chance of a what? Quarter point cut and a 56% chance. Now, that's by the March. That's by basically March. I actually put it at even higher than that. Okay, 50 basis point cut, I would say, is not only baked in, but if we see any more selling this next week, they're absolutely going to come out and do something earlier than that. In fact, it wouldn't surprise me. I was thinking this morning it was going to happen. Look at this. By the April meeting, okay, we're all but assured, okay, not even for a 50 basis point cut, right? They're actually pricing a 45% chance now of what? 75 basis point cut, and it just goes from there. People, we're going back to zero. We're absolutely going back to zero in terms of the interest rates. Now, we have a problem, though, with this. The Fed, okay? Well, this is a little bit, okay, of a discussion of this viral conversation, neither here nor there, okay? The problem with the Fed, at some point, cutting rates may not help. Now, if you look at the Fed versus, all right, widespread, concerns, obviously, of COVID, which, again, I am really dispelling a lot of the rumors that are out there, whether it's a pandemic or not, neither here nor there, okay? The disruption, obviously, could be absolutely, massive. And the Fed cutting isn't necessarily going to help that. I'm going to make a completely separate argument over here. The Fed cutting isn't going to help. It didn't help in Japan. Why should it help here? Negative interest rates hasn't worked in Japan, okay? What we are very likely to see, and this is where I'm going to warn you, okay, and where I think there could be some huge sell-side activity. If the Fed does come out and cut, especially if they cut early, we may sell into it. Okay, this is what we call turning your back on the Fed. Sooner or later, we're going to turn our backs on the Fed. That's when the Fed's going to lose control. That's when the marketplace is going to get infinitely more volatile. And I don't mean because the VIX is going to spike infinitely more volatile. I'm just going to explain it in the context of this. Okay, the S&P 500. The S&P 500, look at it over the last 10 years. Can you tell me realistically that we couldn't be down back to 200 inside of the spiders? I'm not saying we're going to go there, but the realistic is, hey, listen, we could turn our back on the Fed. Negative interest rate policy isn't necessarily working. The Fed can feed you, okay, all that you want, but nothing matters unless you're actually got P&L on the bottom line, because the Fed, okay, they ain't going to get it done. They're not going to get it done. They're not going to actually drive growth. If the marketplace realizes that and that the Fed is backed into a corner, it's over. There's going to be huge sell-side activity. There's one very alarming area involving that specifically today, and that's this. Let's actually take a quick glance at gold. Now, this is one that's going to perplex a lot of individuals here, but I'm just going to bring you into a little bit of scope. There have been for decades, people come out and they say, in times of worry, in times of uncertainty, buy gold. Really? How did gold fare today? Got just crushed. Right? Look at gold. Thing is down $55 today. Why? It's alarming. Okay. Now, I could come up with several different reasons of why gold might be down. Again, several different reasons of why gold may actually be down. One of them, hey, maybe gold knew that the marketplace was going to rally. I don't buy that for a second, because the marketplace didn't rally until literally the last couple of seconds of the trading day. So I'm just not going to buy that one. All right. Are they out there? Are they buying the dollar? No. Well, if they were buying dollar, I would buy into, the dollar was so strong that they crushed gold, right? It's a commodity. All right. I look at gold as a sign of the times over here, and that's this. Somebody has to sell gold. They don't want to sell gold. They have to sell gold. Why? To cover their other debts. When all else fails, listen, gold doesn't perform well, does not perform well, okay? When you start to get a marketplace that is in the perils of a very, very serious sell-off. Why isn't gold going to help? Because firms sell gold to pay debts elsewhere. Plain and simple. If that's what this is, again, it's the beginning of a much larger sell-side activity campaign onto which we could actually see things, why do we sell gold? For reasons like margin calls. Why do we sell gold? Because major banking institutions are in trouble. Literally, firms, okay, may be in trouble. We'll actually see in the coming days. There are a huge amount of things to think about. Now, something I'm going to be talking about a tremendous amount in the coming days. We're going to start to play what I term the sector rotation game. We're going to go energies, utilities, consumer staple, home builders, right? These are going to be 4 areas that are absolutely going to be in play. And the irony of this is, like, utilities, that's low beta stuff, right? That thing's not even supposed to move. Again, I was bringing this up a little bit earlier. The utilities, though, just getting smoked. You look at, like, the energy sector, right? The energy sector, as I said, getting annihilated. We're going to look for bounce and fade trades in here. What I believe that we're going to do is literally be rotating capital. I would actually guess energy should see some very substantial bounces in the coming days. In fact, let's actually pull up XOP. And by the way, with something like XOP, put my money where my mouth is over here. Okay, I don't talk about anything that I don't trade. This is actually me selling, okay, out of the money puts and buying call spreads in here. So I'm actually selling out of the money puts, buying call spreads, and I even loaded up on a couple of shares of this. So I'm actually building and constructing a bit of a position. Ironically, up about $200 today with a 55-cent move, but I was working into these positions throughout the course of the trading session. Nevertheless, okay, we're going to be looking for bounce and fade trades, okay, again, consistently. And you're going to see me even like home builders, which got annihilated. There will be bounces and there will be fades. Okay. But what I really like is I know that people get very fixated, like, oh, let's trade Apple, let's trade Netflix. Okay. You want to be involved in a Netflix? Do you want to be involved right now in a $369 behemoth with a 70% implied volatility? When I can make a quick argument that you could possibly make more money in something like here, you want a sector rotation over here? Here's a fun one. Why not go into something like HYG, which is junk? It has 21% implied volatility, okay? But guess what? Look at that outsized move and a bounce back to the upside. It's bounce and fade trade time. Get ready for it. We're going to be talking about it a tremendous amount in this next week here at TheoTrade. People on the verge of a bear market. Thanks, everybody, for joining us here for this weekend's update. Now, a very special announcement. Allow me to invite you, TheoTrade 2020 live event. This year's theme, the Decade of the Trader. We've already sold out the VIP. The first tier is completely sold out. We still have early bird tickets right here, right now. Get your ticket, TheoTrade.com. Again, it's TheoTrade.com/live. Now, this is going to be right here in Scottsdale, Arizona. After you actually visit us, you're probably never going to want to leave. It is May 28th through the 30th. It's $997. Click add to cart. Again, TheoTrade.com live. This is really all of the TheoTrade instructors are going to be there, from Brandon Chapman to myself. For example, I'm going to be doing a topic, Decade of the Traders, asset bubbles, non-existent interest rates, algorithmic trading. We're going to be talking about, again, the skills that you are going to need to survive effectively in the next decade of trade. We're going to talk about good trades gone bad, battle of the bands, price action intensive, inside the NQ with Tony Rago. We're going to get into mindset, mentality of trade. We're going to have Slim Miller out here. I could go on all day about all the topics and details that are going to be covered here live in Scottsdale. Again, May 28th through the 30th here, 2020. Book your ticket right now, TheoTrade.com/live.